So in this lesson and in the next lesson, we're going to cover something called accounting for changes. Accounting for changes, because these changes sometimes come up. And you can kind of categorize accounting for changes into 4 buckets or 4 categories. One is change in accounting principle, which involves the fact that we have an accounting principle. Maybe the accounting principle is over marketable securities. Maybe it's how you account. There's an accounting principle over inventory costing or full cost accounting, or some accounting principle on how you amortize an intangible asset. What happens is the authorities over governing accounting principles, like the Financial Accounting Standards Board or the Securities and Exchange Commission, or someone comes out and says, we're going to change how we do accounting. And sometimes you as a company may have some latitude on how you do accounting. Like if you meet certain rules, maybe you can expense something or capitalize something, and you've been doing it one way, and you decide with this new president comes in, new management comes in, they decide they want to do it differently sometimes. See, a new CFO may come in, Chief Financial Officer comes in, and he disagrees with a certain accounting principle, and he realizes he's got some latitude and he wants to change it. And when you have a change in accounting principle, that has to be treated retroactively. We'll talk about that in this lesson. Another kind of change that can come up is the fact that you have an estimate that impacts accounting and you decide to change that estimate. So maybe you estimated depreciation, and you estimated depreciation based on a useful life of 5 years, and now you realize, well, whoops, it should be 10 years. We've changed our estimate. This asset will last a lot longer. So these changes in estimates will impact how you do accounting. So we'll have to account for that kind of change. A third kind of change that can come up is change in entity. And a change in entity has to deal with the fact that the business itself has changed. Either the business literally sold off a major part of its business, or maybe it went out and acquired another business, but there's been a major reorganizational change. The scope of accounting within that entity has changed dramatically. So a change in entity can take place because businesses go through a lot of mergers and acquisitions. And finally, you might have corrections. A correction is an error. You made a mistake. You posted something incorrectly. You did an incorrect calculation. Now you got to go back and fix the mistake or the error. So in this lesson, we'll talk about change in principle. In the next lesson, I'll cover these 3. So let's just focus on change in accounting principle in this lesson. And what this is going to require us to do is we're going to have to analyze and assess the impact of that change in principle retroactively to see what the impact is on the bottom line net income. So what you have to do is you have to analyze and figure out the impact, because as you publish comparative financial statements, the user will want to know, how does that impact when I compare the bottom line year to year to year, what would it have been had you implemented this change retroactively back to when you disclose your financial statements. So as a minimum, you must disclose under change in accounting principle. You need to disclose the nature of the change. So this is the scope of the change, the nature of the change. What is the change? What's the nature of the change? What is it? What's the scope of it? Why are we making the change? And then the bottom line is, what's the impact on net income? So what's the impact in the current year? So you want to assess the current year's impact. And you also want to look at I'm not writing this too well, cumulative. This is cumulative impact, current impact. And the way you will disclose this, you can disclose this as an extraordinary event on the income statement, because a change in principle is not something that happens very often. Because it's infrequent, it's unusual, since it meets those criteria. Unusual in nature, infrequent in occurrence, since it meets those criteria for extraordinary items, it typically will be reported as an extraordinary item on the income statement because we want to disclose the impact below the normal operations of the business. So, and I would also advise to put this kind of information, describe what it is, why the change is being made, maybe a new pronouncement came out, something like that. This should be disclosed fully in the footnotes of your financial statements, okay? So again, this gets back to my theme that I've hit on a few times is full and adequate disclosure. Don't just disclose in the financial statements, but disclose in footnotes and other information so that you cover all the bases, so you have full, complete, adequate disclosure. So a change in accounting principle is going to be retroactive, which means you have to go back and assess the cumulative impact, and you will disclose it in your financial statements as an extraordinary item on the income statement, and you will also include some footnotes to describe what it is and why it's taking place. So in the next lesson, we'll cover these three kinds of changes because these could come up. I've had this happen, corrections to errors, and I've also had this happen. And I've gone through mergers and acquisitions. I haven't been directly involved in this, but these two will come up from time to time regardless if you're a bookkeeper or an accountant. So we'll cover these in the next lesson.